right? So credit ETFs, we're diving into those today. They're basically like baskets of bonds, right? Traded on exchanges just like stocks. Instead of buying like individual bonds, you can buy a slice of the whole credit market pie.
Yep, that's the idea.
Cool. So for this deep dive, our mission, should we choose to accept it, is to explore, well, some of the top-performing credit ETFs. And we're looking at data as of April 2024. We'll be focusing on things like assets under management, how easy these ETFs are to buy and sell, liquidity, and those expense ratios, of course. Oh, and we can't forget about actual performance, right? How well they've done.
Right.
Got to see if they actually live up to the hype.
For sure.
But of course, standard disclaimer here, we are not giving financial advice, just digging into some interesting data. And trust me, there are some pretty wild numbers in here. We're talking about ETFs so massive.
Oh, yeah.
One of them is sitting on over $92 billion in assets.
It's mind-boggling.
I know, right? So to kick things off, let's start with the heady hitters in the investment grade world. LQD and BND, have you heard of these?
Oh, absolutely. Those are the giants, no doubt about it. If you're looking for that lower risk investment, generally issued by companies and governments that are considered pretty stable. LQD and BND, those are the EPFs you got to know.
Gotcha, okay.
So LQD, the iShares iBoxx iInvestment Grade Corporate Bond ETF, that one focuses just on corporate bonds.
Okay, so just corporate.
What BND? The Vanguard Total Bond Market ETF.
Okay.
It takes a much broader approach. Includes government bonds, even mortgage-backed securities in the mix.
Oh, wow. So it's like LQD is a carefully curated selection of corporate bonds, and BND is like the full buffet experience, right?
Yeah, that's a great way to put it. And both have incredible scale. LQD manages over $67 billion.
Wow.
And BND, even bigger, over $92 billion under management.
Jeez. Those are some serious numbers.
Oh, and here's where it gets really interesting. Their expense ratios are incredibly low. LQD sits at 0.14%.
Okay.
And BND, a tiny 0.035%.
Wow, that's almost nothing.
Right. That means more of your returns stay right there in your pocket.
Yeah, those low expense ratios are definitely appealing, especially when you're talking about funds that massive. But, okay, let's say someone's trying to decide between LQD and BND. What are the key factors they should be thinking about?
It really comes down to, how much risk you're comfortable with and what you're actually trying to achieve with your investments, LQD, focusing only on corporate bonds. It might be a little more sensitive to, economic ups and downs.
Makes sense.
Compared to BND, which has that added layer to diversification because of those government bonds and mortgage-backed securities.
Ah, I see. So with LQD, it's potentially more volatile, but if those companies do well, maybe higher returns. And BND is more like the steady Eddie option.
Exactly. It's all about finding that balance for your individual needs. And speaking of risk and reward, let's crank up the heat a little bit and talk about high-yield bonds. HYG and JNK, these are the stars of that show.
Now we're getting to the fun stuff. High yield, high risk, potentially high rewards.
Yeah.
That's the saying, right?
Pretty much.
What's the story with these two? Fill me in.
All right, so HYG, that's the iShares iBoxx High Yield Corporate Bond ETF.
Okay.
And JNK, that's the SPDR Bloomberg Barclays High Yield Bond ETF. These are your go-tos if you're looking for exposure to U.S. dollar-denominated high-yield corporate bonds.
Lots of jargon in there, but I think I'm following.
Basically, these ETFs focus on bonds issued by companies with lower credit ratings, meaning there's a greater chance they might not be able to repay their debts.
Oh, so it's a bit riskier.
Exactly. With high yield comes higher risk.
So you're kind of betting on these companies to turn things around, or at least stay afloat so they can pay you back.
Yeah, you could say that.
Sounds a bit like a roller coaster for your portfolio.
It can be for sure.
Okay, so what about the size of these ETFs and the costs? Are they in the same league as those big investment grade funds we talked about?
HYG is the bigger of the two. It's managing over $19 billion.
Okay, still pretty big.
Right, and then J&K comes in a bit smaller at over $8 billion. And as you might expect, their expense ratios are a bit higher than those investment grade ETFs. It reflects the added complexity and risk of managing these types of bonds. HYG has an expense ratio of 0.49%.
Right.
And J&K is at 0.40%.
Okay, so you are paying a bit of a premium for that potential for higher returns. But I guess the big question for our listeners is it worth it? Is that potential reward of high-yield bonds worth the nail-biting uncertainty?
That's the million-dollar question, isn't it? And there's really no one-size-fits-all answer. It all comes down to your own personal risk tolerance, your investment goals, and how much volatility you can handle in your portfolio. Some investors, They thrive on that excitement. But others, they might prefer a smoother, more predictable ride.
Yeah, it's like choosing between a wild whitewater rafting trip or a leisurely kayak down a calm river, right? Both have their appeal. But it really depends on what kind of experience you're looking for.
Exactly. And let's say you're looking for something a bit more targeted, maybe something that hones in on a specific part of the bond market. That's where VCIT comes in.
Ah, okay. Tell me more about VCIT.
So VCOT, the Vanguard Intermediate Term Corporate Bond ETF, it focuses specifically on U.S. investment-grade corporate bonds, but with maturities between 5 and 10 years.
Maturities. Can you break that down for me? What does that even mean in this context?
Absolutely. Maturity refers to the length of time until a bond reaches its end date, at which point the issuer repays the principal to the bondholder. So a bond with a maturity of 5 years means you'll receive your principal back in 5 years, along with any interest payments along the way.
Gotcha. So it's like the expiration date. Why does this matter?
Well, bonds with different maturities, they react differently to changes in interest rates. And interest rates, believe me, they can have a massive impact on bond prices.
Interesting. So the maturity date is like the finish line for bond. And interest rates can throw some unexpected hurdles along the way.
You got it.
So how does focusing on intermediate term bonds, like VCIT does, how does that play into this whole interest rate game? What's the strategy there?
That's where it gets really interesting. You see, bonds with shorter maturities, they tend to be less sensitive to those interest rate changes, while those with longer maturities can experience greater price swings when rates move. By focusing on intermediate-term bonds, VCIT is trying to strike a balance. It seeks to capture some potential for growth while mitigating some of that interest rate risk.
So it's kind of a middle ground approach. Not too short, not too long, aiming for that sweet spot.
Precisely. And it seems like a lot of investors are interested in this approach. VCIT has over $47 billion in assets under management.
Wow, that's impressive.
It is. But let's not forget about another player in the investment-grade corporate bond space. IGB, the iShares iBoxx investment-grade corporate bond ETF.
Wait a minute, IGB, that sounds familiar. Didn't we talk about LQD earlier? Which is also an investment-grade corporate bond ETF. What's the difference between these two? Are they basically twins?
They might seem very similar at first glance, because they both track comparable indexes of U.S. dollar-denominated investment-grade corporate bonds, with maturities of at least 1 year. But there is a subtle yet crucial difference.
Ooh, intrigue. I'm all ears.
It's their expense ratios.
Ah, those pesky fees. Tell me more.
So IGB has a slightly lower expense ratio compared to LQD, 0.06% versus 0.14%.
Okay, I got to ask. What's 0.08% really going to do for me?
I know it seems tiny, right? But here's the thing. Even small differences in those expense ratios, they can make a surprisingly big impact over the long haul.
Really?
Yeah, it's because those fees are eating into your returns year after year, compounding over time.
It's like those little ants at a picnic. 1 or 2 might not seem like a big deal, but suddenly they're everywhere, taking over your food.
That's a fantastic analogy. It's easy to overlook those small fees, but they can really make a difference in your overall investment outcomes, especially if you're investing for retirement or other long-term goals.
Okay, that makes a lot of sense. So are you saying we should always just go for the ETF with the absolute lowest expense ratio, no matter what?
Not necessarily. Expense ratios are just one piece of the puzzle. You also need to consider the underlying holdings of the ETF, its tracking error, which is how closely it follows the index it's designed to track, and any other unique characteristics that might make one ETF a better fit for your specific needs, even if it has a slightly higher expense ratio.
Got you. So it's not just about the fees, it's about the whole picture.
Exactly. It's about weighing the pros and cons and making informed decisions.
Okay, I think I'm starting to get it. It seems like we've covered a lot of ground already, from those massive investment-grade funds to the high-yield thrill rides, and even those ETFs that zero in on specific maturity ranges. I'm starting to see why you need a deep dive to navigate this world. But before we get too carried away,
it's like super important to remember, we are not giving financial advice here, you know? We're just kind of exploring some cool info about credit ETFs.
Yeah, for sure. Think of this more like a guided tour of the credit ETF landscape, you know? We're highlighting some key landmarks, pointing out some interesting features along the way. But the ultimate decision of whether to invest or not, and which ETFs to pick, that's entirely up to you and your financial advisor, of course.
Right. Always good to consult with a professional.
Absolutely. So, big picture, what are some of the key takeaways you've gotten from our exploration so far?
Well, for me, The biggest thing is just how diverse the world of credit ETFs really is. I mean, we've seen it all, right? From those massive low-cost funds that track broad segments of the market, like our buddies LQD and BND,
Good giant.
to the more specialized ETFs that focus on super specific niches, like high-yield bonds
Yeah.
or intermediate-term maturities. It's like there's a credit ETF out there for every taste and risk appetite.
Totally. It's like a whole buffet of bond options.
Exactly. And it shows the power of ETFs as an investment tool. They give you access to all sorts of asset classes in a way that's convenient and cost-effective, you know? You can basically build a diversified bond portfolio
All right.
with just a handful of ETFs.
It's like having a professional chef curate a gourmet meal for you instead of trying to cook everything from scratch.
Yeah.
Way less hassle and probably a lot tastier.
Right. That makes it so much easier.
Totally. But just like with any investment, it's super important to do your research and choose the right ingredients, so to speak.
Absolutely. And that leads us to another key takeaway. You got to understand your own risk tolerance and investment goals before jumping into any ETF, credit-focused or otherwise.
Right. Risk tolerance is key.
Are you seeking stability, like investment-grade bonds, or are you ready to embrace some volatility for the potential of higher returns with those high-yield bonds?
Yeah, it's like choosing between a leisurely stroll through a botanical garden
Oh.
or an adrenaline-pumping zip-lining adventure through a rainforest. Both can be amazing, but it's all about your personality.
I love that analogy. It's spot on. You got to align your investment choices with your personal preferences and your financial circumstances. There's no one right answer when it comes to risk tolerance. It's about what feels right for you.
Yeah, totally. And don't forget about those seemingly small details, like expense ratios and tracking error. They can really add up over time, especially for long-term investing.
Oh, absolutely. It's easy to get excited about potential returns and totally overlook those little fees, you know, or how closely an ETF actually tracks its underlying index. But as we've seen, those details can have a big impact on your investment outcomes.
It's like comparing vacation packages. One might have hidden resort fees or less desirable accommodations, while the other might offer way more value for your money, even if the price tag looks a little higher at first.
Exactly. You always got to read the fine print.
Always.
And keep in mind, this is just a starting point for your own exploration. We've given you a taste of the credit ETF landscape, but the real adventure is when you start digging deeper into the ETFs that catch your eye.
Yeah, we've provided the map, but you get to choose your own path. Explore the territories that fit your goals and risk tolerance.
Exactly. It's your journey.
So for our listeners out there, what questions should they be asking themselves as they embark on this credit ETF adventure?
Ooh, that's a good one. I think a good starting point is thinking about how credit ETFs might fit into their overall investment strategy. Are they looking for income generation, capital preservation, or a mix of both?
Yeah, got to figure out what you want to achieve.
Right. It's all about finding the right tools for the job. You wouldn't use a hammer to tighten a screw, right?
Exactly. Makes sense.
Each tool has its purpose and its limitations.
So true.
Once you're clear on your objectives, you can start researching specific ETFs that align with those goals. And don't forget to consider those factors we talked about: expense ratios, tracking error, the underlying holdings.
Right, it's like shopping for a new gadget, right?
Yeah.
You wouldn't just buy the first one you see. You'd compare features, read reviews, and make sure it fits your needs and budget.
Precisely. Knowledge is power when it comes to investing. The more you know about different options, the better decisions you can make. Decisions that truly align with your goals and risk tolerance.
Couldn't have said it better myself. So, dear listener, are you ready to take the wheel and chart your own course through this exciting world of credit ETFs? We've given you the compass and the map. Now it's time to set sail and see what treasures you can find.
I love that. Go explore. This deep dive was just a taste of the vast, ever-evolving landscape of credit ETFs. The real adventure starts when you dig deeper, do your own research, and figure out how these ETFs fit into your own unique investment strategy.
So much to discover.
There really is.
Now, before we send you off on your investing voyage, we have one final thought-provoking question, just to leave you pondering. So we've seen that most of these top credit ETFs, they focus on the U.S. market, right? But what about the rest of the world? What about the global credit landscape? That's a really good point. It's like we've been exploring this whole, a lush, vibrant ecosystem of U.S. credit ETFs, right? But you're saying there's a whole world out there.
Yeah.
Maybe other continents with totally different kinds of ETFs?
Exactly. And just like you want to diversify your portfolio, Across different asset classes, to help with risk, diversifying geographically can be beneficial too.
Okay. Yeah, that makes sense.
Different regions of the world, they have their own economic cycles, political
Mhm.
landscapes, and different interest rate environments, of course.
Right.
So by including some international exposure in your fixed income allocation, you might be able to reduce volatility even more and potentially get better returns over the long term.
So it's like, I don't know, adding some spices from around the world to your recipe instead of just sticking with salt and pepper.
Yeah, exactly. A little more flavor.
Yeah, you could add a whole new dimension to your portfolio.
For sure. But of course, investing internationally comes with its own things to think about, like currency fluctuations and potentially higher risks in some regions. It's not something to just jump into without doing your homework.
Right. Got to do your due diligence. Sounds like a topic for another deep dive, maybe.
Definitely. Always more to explore.
Well, I think it's time to wrap up our deep dive into this fascinating world of credit ETFs. We've gone from the giants of investment grade to the high-yield, kind of riskier options, and those ETFs focusing on specific maturities. What a journey.
It's been a lot of fun.
It has.
Hopefully you've picked up some good insights along the way. This is really just a quick look at the, vast and always changing world of credit ETFs.
Right, just a starting point.
Exactly. The real adventure begins when you start digging deeper. Do your own research. Figure out how these ETFs could fit into your own investing plan.
So for our listeners out there, are you feeling ready to embark on your own credit ETF expedition? We've given you the tools, the knowledge, time to set your compass and see where it leads you.
Go explore. The world of fixed income is waiting.
And remember, knowledge is power in investing. Keep learning, keep asking questions.
Absolutely. Never stop learning.
And most importantly, don't forget to have fun along the way. Investing shouldn't feel like a chore, right?
Definitely not.
It should be engaging and intellectually stimulating.
I agree.
Embrace the challenge. Explore all the possibilities. Who knows, you might just find some hidden treasures out there.
Happy investing, everyone.
That's it for this deep dive, folks. Thanks for joining us, and we'll catch you next time.